a put ratio back spread. You create this trade by selling one at the money put and then buy two or more further out of the money puts. You do a trade like this when you expect the market to make a substantial move down after a period of stagnation or expect a trend reversal. The objective of this trade is to put it on as a credit, a free trade, or very, very cheap. If the trade is done as a credit, the profit is limited on the upside to premium collected. In other words, if the market's above the short put come expiration, you'll only keep the credit. The profit on the downside is unlimited as long as the market's below your long puts. Now, speaking of risk, the risk is limited to the difference between the short and long option plus or minus the net premium, depending if you got a credit or a debit. If the market expires above the short put, your risk is limited to any premium paid for the spread. At expiration, maximum loss is realized if the market is trading at the long put strike price. So this is a type of trade where you either want to be very, very right or very, very wrong. In other words, being very, very right, the market falls out of bed and goes down, or very wrong and it doesn't go down at all and just goes up. If it only goes down a little, this is where you're going to take your maximum loss. Okay, here's an example of this trade. We're going to be selling a 95 put and buying 289 puts in the July belly contract. We're going to sell the 95 put and collect $1,572. We're going to spend that money by buying 289 puts for a total of $716 each. When we get filled on the trade, we actually receive a credit of $216. Now, in a trade like this, our break even, where we start to lose money, there's several different layers of risk here. Anything above 95 will make the $216. We'll get to keep all of that. However, if the market's below 95 but above 89, we could lose as much as $2,400 minus the $216 we collected, or just under $2,300. However, if the market's below the more the market goes below 89, well, the more we'll make. Now, the break even on this trade, where you need the market to go to start receiving pure profits, would be 6 cents below 89 or to 83 cents. It's looking like it's asking the market to do a lot, but let's see what happens. 28 days later, the market does just that and falls out of bed. However, because the market is just at your break even, you're seeing a small profit of only $640. You add that on to the $216 and subtract commissions, and you get a net of $706. 28 days later, the market continues to go down, and that unlimited profit potential kicks in, and you're now up $4,000. 28 days later, the market continues to go lower, showing you just the power of long put options. Now, had the market finished at between 89 and 95, you could have lost $2,400. If it was above 95, you would have actually made money. So you have two profit zones, one here, very small and limited, or one here, unlimited. And you have one loss zone, which is here. And the maximum of that, it would be $2,400 minus $216. An exciting way to trade if you have the stomach for it. Now remember, there is a substantial risk of loss in trading currencies, futures, and options. Past performance is not indicative of